That is the accumulated debt the United States owes the world. It's a number that's simply too large to comprehend. Imagine being in debt just for being born, $560,523 in debt to be exact and counting. That is what every American is facing right now. It's no surprise if this figure balloons even as you are watching this video. Get ready for an interesting episode of Do Academy as we dive headfirst into the wild world of the United States debt crisis. What is a debt ceiling? The US government has been on a spending spree over the years, racking up a deficit that averages nearly $1 trillion every year since 2001. To fund their spending extravaganza, they had to issue debts, commonly known as US Treasury bonds, which are usually swooped up by investors due to their reputation of being one of the safest investments in the world. But there is a caveat. They have a debt ceiling, which was created by Congress in 1917. It sets a maximum amount of debt the government can pile up. However, believe it or not, they've had to increase that ceiling at least 100 times in the last 82 years. It's like they're playing a never-ending game of guess where's the ceiling, and they've always got it wrong. Over the past century, raising the debt ceiling has become a relatively routine procedure for the US government. In fact, there are multiple incidences where the debt rose quicker than the debt ceiling. Whenever the Treasury Department could no longer pay the government bills, Congress must act quickly to avoid a potential default. In May 2023, the Treasury General Account is once again close to hitting rock bottom, leading to yet another chapter of debates over the debt ceiling. What happens if the US government breaches the debt ceiling? US plunges into chaos. Breaching the debt ceiling is treacherous terrain. While it may seem like an unthinkable scenario, let's not forget the unimaginable has indeed happened before. The repercussions were nothing short of catastrophic for the United States and the global economies as well. Like a game of financial Jenga gone horribly wrong, the government's ability to finance its operations, be it national defense or funding vital entitlements such as government healthcare and social security benefits, has come to a screeching halt. Hardships for all Americans. According to Goldman Sachs economists, a breach would immediately halt about 1/10 of the entire US economic activity. That's not all. A whopping 3 million people would lose their jobs, based on research by the center-left think tank Third Way. The average 30-year mortgage would skyrocket by an additional $130,000, leaving potential homebuyers feeling like they've been hit with a financial wrecking ball. But wait, there's more. In a valiant effort to stave off the massive depreciation of the US dollar, interest rates would have to be raised, adding another staggering $850 billion to the national debt. A pounding blow to the US dollar. The economic world is interconnected. A breach of debt ceiling could send shockwaves that reverberates across the globe. Now, let's talk about the domino effect which will affect the global economy as over half of the world's foreign reserves are held in the mighty US dollar. But if a breach were to occur and the value of USD weakens, these foreign reserves could take a hit, causing a ripple effect to emerging economies. Low-income countries with high debts, that are already walking the tightrope of financial stability, would see interest payments become more challenging, as denominated debts in other currencies become more relatively expensive. It's like adding salt to an injury, kicking an economy when it's already weak. How should you prepare for the varying outcomes of a debt ceiling debate? Impasse on negotiations. Government shutdown. History is wise and sometimes the wacky teacher of life lessons. During the recent government shutdowns, the market initially declined but recovered soon after. It is important to note that during those years, inflation rates were relatively low, nestling comfortably below the Federal Reserve's mandate of 2%. Now, in April 2023, where things have taken a wild turn. Inflation rates are standing at a whopping 4.9%, more than twice the Fed's mandated threshold. To tame inflation rates, the Fed is embarking on a series of rate hikes and quantitative tightening operations. At times like these, investors are required to exercise extreme caution, as the Fed might not come to your rescue. As Fed Chairman Jerome Powell conveyed during a conference that the US Federal Reserve is unlikely to be able to protect the US economy from the damages caused by a failure to raise the federal debt ceiling. In a case where rescue is nowhere to be seen, safe haven assets like gold, the Japanese yen and Swiss franc will be the market's darlings. Congress finalizes a deal. An intricate dance of congressional deals and their ripples on the market. In a scenario where Congress finally strikes a deal, there's another fascinating element to consider as investors. The US government replenishes the Treasury General Account, with newfound vigor. Massive liquidity will be squeezed out of the markets. It's like squeezing a lemon till it's completely drained of its juices. This sudden liquidity crunch can leave investors feeling a bit parched, desperately searching for that elusive sip of financial relief. According to the astute estimation of Goldman Sachs, it's time to brace yourselves for an influx of treasury bonds worth a whopping $600 to $700 billion, all flooding the market in a matter of weeks. And that's not all. They also predict that the Treasury Department will eventually supply a total of $1 trillion worth of treasury bonds. To put things into perspective, it's akin to removing the entire worth of Nvidia from the market, which is valued at a staggering $961 billion. In fact, an analyst at the Bank of America suggested that the deluge of treasury bonds would have an impact equivalent to the Fed's 25 basis point rate hike. While it may seem all doom and gloomy, it remains to be seen if liquidity supplies will arise from the overnight reverse repo market, which currently has over $2 trillion in investments. If it does, high-yielding defensive shares and treasury bonds will be greatly favored. Trying to invest amidst the chaos of a debt ceiling can be very tricky and exhaustive. Historical performances can guide us, but it does not write the final chapter, nor does it predict the exact future. As we stand at a crossroad, let us approach the future with cautious optimism, armed with knowledge, and ready to adapt to whatever surprises the market may bring. Thank you for joining us through this fascinating interplay of events and economic challenges. Be sure to like, share, and follow for more actionable investment insights now.